So what is a qualified retirement plan? Well, that's what we're going to discuss in this video right now. What defines it? What's the whole purpose of it? Is there something better that you could be doing besides doing a qualified retirement plan? Well, I want to get into that today to help you understand what might be a better solution for you. So a qualified retirement plan is really kind of a fancy name for any plan that's been sponsored or created by the government, specifically the IRS. For example, if it has a code like 401 subsection K, that's actually a tax code. 403B, for those of you that are teachers, you already know what that is, right? That's your own retirement plan. You have IRAs, there's 457s, you got all these different plans that are out there. These are examples of qualified retirement plans. The typical thing about a qualified retirement plan is that you put in with pre-tax money, meaning you put the money in, you're not taxing that money at all. Now, if you're just putting it out of pocket, it's even a tax deduction on a tax of that year. However, it grows tax deferred and then comes out taxable down the road. You get taxed at ordinary income tax. Now, these qualified plans all seem to have basically the same kind of rules. There's usually an age minimum. Most of them are 59 and a half, although there's a few of them that might be age 55, but you have to wait till 59 and a half. If you try to access it before that age minimum, you will be slapped with a 10% penalty plus taxes. Furthermore, you got to pull it out by a certain age too. So you have the age 72. If you don't pull it out by 72, guess what? They slap you with a 50% penalty. That's 50% penalty of the money you should have taken out. So they require, from age 72 onward, you're required to pull out a certain percentage each year, and that percentage increases as time goes on. If you don't pull that money out, they tax it at 50% of what it should have been. And that just goes right to the IRS. That doesn't even go into your pocket at all. So there's a lot of little hoops to jump through. There's a lot of different limitations, even limitations of how much you can contribute each year and so forth. And this even applies if you got SEP IRAs and simple IRAs. I mean, all these things. Typically, if these are plans that are IRS created, they're qualified retirement plans. This also means that the IRS is the boss. That means that this is not your money. The IRS is technically owning this account. You're the benefactor. And I have some people always debate me. They're like, that's not true. It's my money. I look it up. It says my name on the account. No, you'll notice in the contract of it, it says for the benefit of your name. It's for your benefit. You're a benefactor. So yes, you put your money in. You are the benefactor, but the ultimate controlling partner is the US government, or specifically the IRS. Now, you got the Roth IRAs, for example. That's kind of an example of a qualified plan as well. Roth IRAs have their own rules. You put in with after-tax dollars, it grows tax-free, comes out tax-free. Now, with the Roth IRA, that was actually Congress that helped put that into play. And so that one's a little bit differently controlled. That one's controlled more by what Congress has voted on it, which means they can also change the rules. So just be aware, any qualified plan, even if you get an annuity that's a qualified annuity or IRA annuity, those kind of things, once again, have all these rules. Now, is this bad? Not necessarily. No, there can definitely be purposes for having these plans. But I just like people to be very well aware that this is not always the best plan, and it's not the only plan. It's not always the option. And it doesn't mean it's always bad, but it doesn't mean it's always the best, right? And so you have to just be aware of these rules and if it really fits what you're trying to do. This is why I always come back to, what is your objective? What is it you're trying to accomplish? Because if you're looking at these qualified plans, you say, well, yeah, but I really don't want to wait till 59 and a half. I want to have financial freedom sooner. Well, then why dump all this money in the qualified plan? Well, Chris, you don't understand, because I work for a company and that company matches my contributions in my 401k. And so I got to keep putting money into that. Yeah, but you want to retire sooner. But they match me my money. That's like free money. Why would I pass it up? Oh, it might be because the options you get with those 401k plans stink. They don't even return the stock market returns. So your match just makes up the poor performance of those funds. Oh, so the match doesn't really matter? Not really. Maybe adds a little bit, but not much. You could probably do better on your own. So just be aware of that there are a lot of different scenarios. Some make sense. For example, if you want to retire in your 60s and 70s, great. You know what? Qualified retirement plans can work. They can change the rules at any time. They can bump up the age from 59 and a half to something else if they choose to, and you just have to go with it. They are in control. Personally, this is me. I'm not a big person on trusting the US government or the IRS for that matter, because I know how they're spending money right now. I don't really trust that they're going to lower my tax brackets in the future, nor do I trust the fact that they're going to be wise spending with my money. And so I like to keep more money in my control. This is me personally. You might like it. I'm just not that kind of person. And so I like to store my money elsewhere. Well, where else can you store money besides a qualified plan? And just, like I said, qualified plans can be great. Here's one example of where a qualified plan can work and you still have more control, even though you can't control all the rules. One way is to do that is to create a self-directed IRA or a self-directed 401k. Now, if you've had an old 401k from work, you weren't sure what to do with it, what you can do is you can actually roll that into a self-directed IRA. And now you can invest it where you want it to. Now, it's true, you can't invest it in 100% of places. You can't go and start trying to buy like, cars with it. You can't go and buy Beanie Baby collections with this because, of course, those Beanie Babies are so worth it. Or fidget spinners. Now, I know those fidget spinners aren't worth crap now, right? Despite what one of my sons claimed he would become a millionaire with fidget spinners, that did not happen. So just so you're aware, you can't buy everything inside of an IRA, but you can buy most things, including real estate, even oil and gas and different types of investments you can actually own inside of an IRA. So there are some cool things you can do, but that's if you self-direct it where you have control and you get to dictate where that money goes versus just picking your vanilla old mutual funds that either your employer offers or your financial advisor offers that's really still crap anyways. So just be aware of that. Now, for me personally, I still don't like to use qualified plans as much because, well, why? Because I became financially free before the age of 59 and a half. I did it twice by the time I was 39. I learned pretty quickly that if I want to have money, I don't lock it in prison out there. I keep my money more liquid and available for today. Now, I could store it in my checking and savings accounts, which I have some money in, of course, but I get paid 0.nothing% from the bank when I do that. Where I store most of my cash, I keep a lot of it, at least my liquid cash that I want to have for emergencies, I keep a lot of it inside of my whole life insurance account. I know it seems weird because I'm using life insurance as a savings account, but it's true. What I do and how we design ours, specifically this max ROI infinite banking strategy you hear us talk about in this channel, what we actually do is we actually lower the cost of the insurance so that the cash inside here, that tax-free savings account that's earning like 6% a year tax-free right now, we're letting that grow more by lowering those costs. And so that's one way that I can use it. So I actually will store a lot of my cash there because I know, for one, if the government changes the rules, even with taxes, they can't change my tax rules because it's based on a contract of when I got in at the time. So those rules are locked in place. Even if they decide to tax life insurance later, which they don't, it's very much the same rules as a Roth IRA. They put in with after-tax dollars, grows tax-free, comes out tax-free. But I don't have all these rules like 59 and a half. I don't have to wait till I'm 59 and a half years old to access the money. I can access it today. And furthermore, and by the way, it's non-qualified because again, I'm not getting all these tax benefits up front, but I am getting tax benefits on the back end because of the insurance protection. That also is safer than putting my money in a bank because banks do often take more risk than insurance companies do. And it's also 100% protected in most states from lawsuits and creditors. I can literally store millions of dollars in here and they can't get to it. Even better, I'm not always completely capped on how much money I can put in these plans. Now, I am capped based on my gross income, not even my taxable income that I report to the IRS, but my gross income, I can put in up to 25% of that. That's a tremendous amount of money you can put in. And understand that even with qualified plans, some of them might allow you to get up into like the 60,000 or so range. That's not bad, right? But I've got clients putting in hundreds of thousands of dollars a year into their life insurance plan that, again, they can get all the same tax benefits as a Roth, but they can put in a lot more money, and they have all these issues where they might make too much money. They have to do different types of Roth, IRA strategies to try to get into a Roth and stuff. Very simple, very easy to use. I don't have to go through all these hoops to try to bypass because I make too much money. By the way, making too much money with Roth IRAs means you're making at least $150,000, $200,000 a year, depending on if you're married or single. So just be aware, Roth IRAs, although they're good, and I like them better than other qualified plans, they're not necessarily the most flexible that you can pay into. So I use life insurance, but then I also use my cash to go and invest and buy things like real estate type of properties. Not just the rental in your backyard. No, I hate that. I like to be a passive investor, hands-off investor. So instead, I'll actually buy turnkey rentals, maybe in a different state where somebody else manages the property for me. So I don't have to deal with the tenants and all the issues that way. I can also lend my money to real estate investors and get paid off that. By the way, lending, which may or may not necessarily have tax advantages to it, you can actually do that inside of an IRA too, which is kind of cool. Even a Roth IRA, so you can actually create tax-free income with that. You can also invest in things like apartment buildings, oil and gas. You can do it into car washes. You can do it even into industrial buildings or self-storage units and all kinds of stuff that you can put your money into and get paid returns. And in many cases, some of those returns even give you some tax advantages too. I even do partnerships. I have a business partnership where we're buying and selling raw land, and I'm making over $12,000 a month with that, with just really over about $500,000 invested. So there's so many different things you can do that allows you to grow your money faster outside of these typical qualified retirement plans that so many financial advisors recommend. All right, so if you're looking for a first place to start, I would start with this. Check out the infinite banking section that we have on our moneyripples.com website. That's one good place to start to figure out how can I get my money outside of these qualified plans, still get it tax-free, and then be able to use it to invest however I want. Go check that out at moneyripples.com today.